I'm Michael Fox, and I'm the publisher of the Prospector News. And today I am joined by two gentlemen who really don't need an introduction, but I'm going to introduce them to you anyways. I have joining me from his home in Chiang Mai, Thailand, which is located in the Golden Triangle. I have Dr. Marc Faber, the Gloom, Boom, Doom editor and publisher. Welcome, Marc.
Thank you very much for having me on your program.
Thank you very much for joining us. Peter, we have Peter Boockvar, who is the CIO of Bleakley Financial Group, and he's in his office in Fairfield, New Jersey, and he's the editor of the Boock Report. Welcome, Peter.
Thanks, Michael. It's a pleasure to be here with you and Marc.
Yes, isn't this wonderful? Technology can take and bring us together from all parts of the world, because it's very hard to get you two gentlemen in the same room at the same time.
Well, I haven't seen Marc since before COVID in person, so it is great to see him again post-COVID.
He prefers not to see me in person, so he doesn't need to drink so much.
Although the drinking might enhance the interview, but let's get down to the interview. We've got limited time and a lot of ground to cover. So we've got a world right now that is really in a bit of a mess, and it's going to affect a lot of things economically. We have two wars, one in Europe with the Russian-Ukrainian conflict, one in the Middle East, in Israel. We have a world that is deglobalizing and moving towards countries working independently of one another instead of together. We have all sorts of geopolitical risk out there. We have inflation, we have, government interventions, we have a lot of stuff. And then to top all of that, we have a U.S. election that's coming up that's going to be highly contested as well. Gentlemen, what's the biggest risk to the world economy out of all that?
I'll let Marc start.
Well, I think that we have all these factors that you just mentioned, but investors are not terribly concerned about them as long as the central banks print money or keep financial conditions easy. In other words, although the Fed in the US has increased interest rates at a rapid pace from essentially 0% to now over 5%, monetary conditions are still expansionary, and otherwise you wouldn't have stocks near all-time highs. You wouldn't have the speculation we just saw in meme stocks. You wouldn't have commodities exploding on the upside in some cases, as we had in the first few months of this year in cocoa and more recently in precious metals. So I think investors are focused on, yes, monetary conditions have tightened and a lot of bad factors do happen in the world. But as long as monetary conditions are expansionary, what's the risk? And if the risks explode, if the war escalates, the Fed will print even more money. So we better be in some assets such as stocks rather than in fixed interest securities and in cash.
And Peter, what do you say to that?
So yeah, Marc is right. I mean, there's the policy being easy relative to restrictive sort of depends on who you are. If you own a piece of real estate and you mortgaged it at 3% in 2021, and that loan comes due this summer, well, you're feeling the pain of higher interest rates, because chances are that 3% loan will reprice to 8%, and your rental income is not going to come anywhere close to covering that. If you are trading GameStop or you are buying corporate credit, you're paying high valuations and very tight credit spreads you're seeing in the markets. So there's sort of this two-lane highway. And also, I think that is seen with what I refer to as a remarkably mixed and uneven global economy. You have India growing at 8%. You have China's growth moderating. You have Germany that is basically flatlining, but Italy and Spain that are ironically doing better because of their tourism industry. Within the US, you have lower income consumers that are in their own personal recession because of the cumulative rise of about 20% in their cost of living, but higher end consumers are traveling and cruising and going out for dinner and benefiting from a 5% risk-free money market fund. You have the pace of existing home sales that are near the lowest level since the 1990s, but you have the pace of new construction that's doing better as builders fill that supply gap and buy down people's high-cost mortgage rates. So it's this rather sort of bizarre, conflicting, mixed picture. And so it sort of depends on where you are sort of on the income level, where you are in terms of your balance sheet, and where you are geography that determines how you're handling this global rise in interest rates that we've seen.
Yeah, no, Marc has mentioned that the Fed seems to be getting two policies that are going contrary to each other. In one hand, they're raising interest rates to try and curtail inflation and bring prices back down. But on the other hand, they're still printing loads and loads of extra new money that is inflationary. Is the Fed kind of playing push me, pull you, or have they abandoned the inflation fight?
Well, I think one of the reasons for high markets, tight credit spreads, and this giddiness is the belief that whatever goes wrong from here, the Fed is going to save us. Central banks are going to save us. They're going to come to the rescue with rate cuts, and everything is going to be fine. And markets are sort of just front-running that belief. I mean, it's no coincidence that in October 2022, the S&P bottomed at about 3,600, just as the Fed was ending the cadence of 75 basis point rate increases and started to slow that pace. So markets all of a sudden shifted to, okay, the Fed's almost done. The dollar peaked in November 2022 on that same belief and then weakened. So it's this, again, the ECB wants to cut rates in June. The BOE may cut this summer. Swiss National Bank has cut rates. The belief that, okay, if the unemployment rate rises in the US, no big deal, recession, no big deal, because the Fed will cut and everything will be fine. So I think where the financial markets are front running that faith in central banks that they'll come along and save the day again.
Marc, can the Fed save us?
This is a very good question. When do central banks fail to stimulate the economy? At what stage? What is the end game? I mean, I'd just like to mention Turkey, because this is a market that 3 years ago was terribly depressed at the end of 2021. Then in 2022, it was one of the best performing markets in the world. It doubled. And recently, Fitch actually upgraded Turkish credit, and Turkey has an inflation rate of around 100%. And it is led by essentially a dictator, Mr. Erdogan. And, purely on economics, someone would have said, this country is very bad and it will collapse and so forth. But if you go to Istanbul and you see this 100% inflation, you walk around, you wouldn't notice it. Life goes on as if nothing had happened. And so I'm suggesting that actually, and here I'm talking about long-term cycles. We have inflationary cycles and we have commodity cycles and so forth and so on, and interest rate cycles. These are long cycles. So we had the peak in interest rates in 1981 and the bottom in 2020. And from this low in 2020, when the 10-year Treasury was at less than 0.6%, we're going to have a rise in interest rates for a very long time, and the rise in the rate of inflation for a very long time, meaning 10, 20, 30 years. And I think investors will have to get used to that, whereby even if inflation is at 20% per annum, stocks can still go up if the Fed keeps on printing money, if interest rates stay negative in real terms. And here I have to say, the statistics that the government is publishing everywhere, but in particular in the US, cannot be trusted by someone who has common sense. The inflation rate, the cost of living increases in America are much higher than what the government is publishing, much higher. And the reason the, say, small business sentiment and consumer sentiment is depressed is that most people are suffering from the increase in prices, and which then have an impact on their profits, on the corporate profits, and on the disposable incomes of people. So the economy, in actual fact, in America is weaker than what the government is telling you, whereas, say, in a country like China, the economy is probably slightly better than what the Western media, another branch of the lying government officials, are telling you. This is my view about the economy and how it is reported to ordinary people.
So in the end of the day, then, you believe that the Fed has lost the inflation battle already, and we're in for a long haul.
They don't want to fight inflation, because fighting inflation would mean to hurt the asset holders, Wall Street. These are the last people the Fed wants to hurt, Wall Street, the paymasters.
He makes a very important point, because starting with Greenspan, we became a very asset price dependent economy, whereas prior to that, stocks reflected their belief on the fundamentals of a stream of earnings. Now it's higher stock prices are supposed to then drive the economy. So I talked about this two-lane economic highway with lower income consumers that don't own a house and don't own stocks, who are suffering from the high cost of living and the high cost of renting if they're not owning. Whereas the higher income consumer is dealing with 5% interest income and high asset prices. So if you had a stock market, if you had an S&P 500 that was a 3,000 instead of 5,000, you can be sure that that alone would drive us into a recession, not necessarily reflecting a recession, if that makes sense. Because the dive that you would see in high-end consumer spending, baby boomer consumer spending, if the stock market fell a lot, I think would be rather dramatic. So central banks, to Marc's point, are purposely trying to keep asset prices elevated. Now, whether they can continue to get away with that is now a question, because the inflation story, statistically now, obviously being higher than what we've seen, definitely ties their hands. And they don't have the same license to experiment as they did with the idiocy of zero rates and the greater idiocy of negative interest rates on top of the idiocy of all this QE. Well, they're more limited in their ability to pull those levers again, as long as inflation still remains high, because having high inflation, they want high inflation. But when you start to get riots in the streets because people are pissed about their cost of living, like you did a couple of years ago, you saw it in France with higher oil prices. I forgot what other country on higher subway fares. When the populace starts to get angry, then central banks have a lot more difficulty in placating asset prices. And there is an important sort of trade-off that they have to make. So the days of zero interest rates, I think for a while are over. I do think that QE could come back for sure, particularly in the US with the exploding debts and deficits. But But the central banks are more limited in their ability to fix things because of the higher rate of inflation than they were pre-2022.
Now, they've increased the interest rates dramatically in a very short period of time, but they have not seemed to really take a bite out of the economy. And as both of you gentlemen have pointed out, there's a lag effect for when people have to renegotiate things like car loans, mortgages, business loans, etc. When do you see these higher rates actually start to take and bite the economy?
Peter pointed out that the increase in interest rates has very different implications on different classes of society. In other words, if you are a large commercial property owner, you own commercial properties in downtown Los Angeles, San Francisco, Baltimore, Philadelphia, New York, and you have a leveraged real estate investment trust, or you are just a leveraged investor, your properties are now down very substantially, partly because of the increase in interest rates, but mostly, and this I have to point out to your question about the ability of central banks to navigate and keep the system going. Their ability is limited because the system changes all the time. 10 years ago, people thought that the commercial property is a very desirable investment. But nowadays, as people stay home and don't want to go to work anymore, the Generation Z excels at being utterly lazy. They don't want to work. They want to work at their conditions. And companies frequently don't like those conditions. And so there's a mismatch of people, and less and less people go to their offices, or because of productivity improvements, offices can be vacated. So we have this disaster in the commercial property market. And this is the problem with money printing. It creates excesses first, and then it creates bubbles and collapses in different sectors of the economy, but not necessarily all at the same time. But say when we talk about the impact of higher interest rates, let me just give you an example. In my company, I keep always a lot of cash. So for the last few years, I had no return because my deposit rate were below 1%. Now I get a deposit rate of 5%. So this is for me not a good investment, because I know that cost of living increases are maybe 7% per annum or whatever. But it is a reasonably good investment considering the alternatives.
No, definitely. Not that we didn't have lots to talk about already, but as we record this, we are 24 hours from when Roaring Kitty has shown up again after a 3-year absence. For those of you out there that don't know who this was the online blogger that started the GameStop meme stock, mania during COVID. GameStop took off just on his appearance on the network again. Are we heading back into another meme stock mania here, guys, with easy money, even though the interest rates are high?
Well, the amazing thing is he didn't even say anything. All he did was post a picture. And not only did that lift GameStop, but all the other Left for Dead meme stock carcasses they tried to revitalize. But that's the stock market. There's a casino mentality. All you need is something like that. It's human nature, never changes. But it does show you that there's a sense of giddiness out there that is not dead. Maybe it was suppressed for a period of time when the Fed was aggressively raising interest rates. But like I said earlier, the market is trying to front run rate cuts, not just the Fed, but I said elsewhere. And they're playing games again. But we know how it ends. If you're a long-term investor or even a short-term student of the market, this is not what you want to see, because usually this coincides with the end of moves. Keep in mind, when this really flamed up in February 2021, that was peak euphoria. That was the top in most stocks. The bigger indices didn't top out until January 2022, but most of the market topped out with this euphoria. So now this can continue for sure, but it's not what you want to see outside of the entertaining aspect of it.
Yes, I remember in the 70s when we saw this happening, we called them these cats and dogs. When they move up, it's about the end of the bull run. But I think it's a wonderful symptom of the current madness in asset markets, where people, they attend seminars, online seminars to speculate in anything that moves with no research and knowledge at all. They think that by going to an online seminar for a few hours a week, they become experts at trading cryptos, at trading stocks, at trading meme stocks and whatnot. Is a crazy world. I think the Generation Z will be the expert generation at blowing off the money that they inherit from the boomers.
I think that might be actually very well said. We've been looking at the economy, we've been looking at the markets. Let's take a look at precious metals. They've been on a tear since early March. Gold has set new highs. I've had it suggested that gold is warning us that the Fed is about to make a misstep. I've had all sorts of people saying gold is doing this and doing that. What are the precious metals actually telling us, gentlemen?
Well, the biggest buyer of precious metals since February 2022 have been central banks, and they've been buying whatever they can hand over fist. The trigger then, of course, pun not intended, was the Russian invasion of Ukraine that then was followed by the freeze and confiscation of half of Russia's central bank reserves. And you can imagine the mentality in China, in Japan, in Saudi Arabia, all these large holders of U.S. treasuries, to see the EU and the U.S. take this action. And a lot of these countries and others made an attempt to say, we need to own less dollars, we need to own less euros, and we need to diversify in an asset that we can hold in our hands and have it stored on site. And then, of course, what's happened since too is countries like China and Saudi Arabia trading oil in something not called the dollar. China buying soybeans and corn from Brazil in renminbi, not the dollar. And that some of these cross balance of payment flows are happening in currencies outside of the dollar. Well, if you have some excess of yuan because of that, well, it's very convenient to just buy some gold with it. And I think that there is a big time secular drivers that is different than how this gold bull market really started. The gold bull market in 2000 started when tech stocks collapsed. Greenspan experimented with 1% interest rates, and that wasn't enough for Bernanke and Draghi, and they obviously went haywire. And that's when gold really became an attractive asset. Now it's actually benefiting in a way from a different form, but still being a currency that central banks and foreign governments want, that is not denominated in dollar, yen, or euros.
Marc, what do you think the gold market's telling us?
Well, the gold market is saying that there is less and less faith and trust in paper money, and that paper money is losing its purchasing power, which has been the case essentially since the formation of central banks. I mean, the Fed in 1913, the dollar has lost its purchasing power, and it will continue to do so, in my opinion, at an accelerating rate. Because I don't want to go into the whole economic theory, but once you're in the money printing business and debt expansion, you have to increase it at an accelerating rate. Otherwise, it has no impact. But I think that the precious metals are not only bought by central banks, but individuals are gradually waking up to the fact that they don't own any of it. Because I move around all sorts of societies, high-class people and low-class people. But when you discuss about investments and so forth, it doesn't strike me that well-to-do people have more than, say, 1 or 2% of their assets in gold. You know, I think that people are grossly underweight gold. And if you look at the portfolios of fund managers, 70% of them, they have hardly any exposure to mining stocks and gold. So with the price of gold going up, the clients and the consulting firms like Cambridge and God knows what all of them are called, they will go to the fund managers and tell them, well, how much of your money is in gold? And if they have less than 5%, they will be told, yeah, you better increase. So I think that actually gold shares and mining stocks still have a long way to go on the upside because they've been in bear markets against gold, and against the S&P for more than 10 years. So they're very low relative to the precious metals physical prices. So that's my view. And I'm not saying that people should own gold because it's moving up. I've been saying this for the last 40 years, since gold collapsed in the early 80s and it traded around 300 and was in 1999 even at $255 an ounce. That was the great buying opportunity. But it's still not terribly expensive compared to the low intellect of central bankers that we have nowadays.
So you think, Marc, that this run in gold is for real this time? It's not another false start?
Gold has been in uptrend for a long time, but of course the uptrend can be interrupted by all sorts of events, like when interest rates are high in real terms, inflation adjusted. This was the case after 1981. Interest rates in the US were high in real terms until, say, around year 2000. After year 2000, they started to print money, and they kept interest rates low relative to the price increases in the economy. And there I have to point out that we in Europe, we have a slightly different view of what inflation is, because in the US, it's the consumer price index that measures inflation among economies. But we say more Austrian-leaning economies, we consider consumer price increases as a symptom of inflation, as well as rising property prices is a symptom of inflation. Rising stock prices is a symptom of inflation. Rising art prices and collectible prices is a symptom. The inflation is basically measured by an increase in the quantity of money. And there has been a lot of increase in the quantity of money worldwide.
Yeah, true that. Peter, did you say a gold run for real this time?
Yeah, so Marc is spot on with all of his points. I mean, at the end of the day, gold has always been and always will be an inflation hedge against the depreciation and the purchasing power of your money. If you had $1 in 1971 and you went to buy some gas, a gallon of gasoline, that $1 would buy you a fraction of a gallon of gasoline, whereas that gold coin you bought in the early 1970s would buy you many gallons of gasoline. So he's absolutely right. And the gold mining stocks certainly have been left for dead. And defining that sort of that apathy with Western investors when it comes to gold, all you have to do is look at the ETF flows out of gold funds over the last couple of years. There's been persistent central bank buying. There's been persistent Western selling via gold ETFs. And just wait until you see those Western investors come back into those ETFs. That's when gold really gets another leg. And just, on an inflation adjusted basis, the $850 1980 high, you're talking 3,200. If you just backed all this money printing that we've seen over the past 15 years with where gold was relative to that prior to all this money printing, you're talking about 5 digits of gold. So there's a lot of upside potential here for the price. And I do believe we're just getting started.
Yeah, here for us gold bugs have been waiting a long time to hear that. We're starting to run the clock out on this discussion. So the last question I'd like to ask both of you gentlemen is, we have the rest of the year. Is there going to be any major shocks to the economy, and where do you think they might come from? And what do you think the effects of that might be?
Well, I think that, as I insinuated before, that for the typical American household, the economy is not doing well. He's faced with cost increases, cost of living increases that are higher than his salary increases. And I'd like to emphasize here that inflation is actually nothing else but a tax. It is a tax that people don't realize. And the tax of inflation occurs because the government spends more than it collects in income taxes and sales taxes and so forth, visible taxes. And so the inflation takes off because of government spending that is financed by the central banks through money printing and the enlargement of money in circulation. But people don't realize it. But the standards of living are going down. That you have to be aware. And I've seen high inflation economies repeatedly in my life. The ordinary people suffer very badly, whereas the rich people, they benefit from high inflation and benefit meaningfully.
Peter, where do you see the shocks?
So I've been for the last couple of years looking at more of a death by 1,000 cuts rather than like an 08 repeat, for example, in the sense of just this adjustment to higher interest rates. And interest rates in an absolute level are certainly not high. But when it comes after 15 years of zero and negative interest rates, they're high. And every day, somebody's loan is coming due that needs to be repriced. And there is a ton of debt that's coming due over the next couple of years. Now, if you're a company that had floating rate debt, well, you've already seen the adjustment quickly. If you are a bigger company that has termed out their debt, or even someone who owns a home that has an adjustable rate mortgage that's been termed out 7 or 10 years, you haven't gotten hit yet. But that train is still coming down the tracks over the next couple of years if interest rates stay high for a while. So like I said earlier, that 3% loan is going to reprice. So that's what I'm more worried about. Now, if the S&P 500 drops notably, well, then that's when you're going to start to see some shocks, because that will be on top of broader problems with too much debt and higher rates and so on. But that remains to be seen. If asset prices still remain elevated, then we're going to have this very mixed economy still. But every company is going to have debt coming due in the next couple of years, and that maturity wall gets bigger and bigger over the next couple of years.
So you see it as a situation where there could be a straw that breaks the camel's back, so to speak.
Well, I think we're sort of nicking away at growth with higher rates. And it's, like I said, death by 1,000 cuts. So it's, the local real estate person is not making it on the front page of the Wall Street Journal, who's handing back the keys to some bank you never heard of. But it's happening every day.
Yeah, it certainly is. Gentlemen, we've run out the clock here, and it's been an absolute thrill to have this discussion. And I hope I have the opportunity to do this again with the two of you in the future.
Well, I'm honored to spend time with my friend Marc again, my dear friend.
Don't say that.
You'll always be
anyway,
my dear
very
friend.
nice to see you, Peter, and very nice to see you, Michael. And let's do it again in a year's time. Maybe we're all more modest and humble than we are now.
Thank you, gentlemen. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.